Welcome to The Explainer. Today, we're going to talk about something pros use to see what's really going on with a company's finances. It's called ratio analysis. It's all about looking past those big, flashy headline numbers to find the truth hidden inside. So, let's get into it.
All right, let me ask you something. You see a headline, right? Company X just posted 100 crore profit. And your first thought is probably, wow, that's amazing. But is it really? The answer might surprise you. It completely depends.
And this is where things get really interesting. Take a look at Company A. Yeah, it made that 100 crores in profit. But, and this is a big but, it needed a whopping 10,000 crores in assets to do it. That's a return of just 1%. Now look over at Company B. It only made half the profit, 50 crores, but it did that with just 500 crores in assets. That's a fantastic 10% return. So I'll ask you, which one of these businesses would you actually want to own? It's a no-brainer, right?
And that, right there, is the magic of ratio analysis. It's like having financial X-ray vision. It lets you see straight through those big, often meaningless headline numbers and get to what truly matters, the real health and performance of a company.
So how do the pros actually do this? Well, they don't just pull random numbers out of a hat. There's a system to it. It's a framework built on 5 key pillars that gives you a complete 360-degree view of any business.
And here they are. You've got activity, which is all about how efficient a company is. Then there's liquidity. Can it pay its bills tomorrow? Solvency, which is about long-term survival. Profitability, the one everyone talks about, is it actually successful? And finally, valuation, which asks the big question, is the price right? Each one of these gives you a piece of the puzzle. And when you put them all together, you get the full picture. For today, we're going to really dive deep into 2 of the most famous ones to get the hang of this whole method.
Okay, so let's zoom in on profitability and valuation. These 2 get most of the spotlight, and for good reason. They answer the 2 questions every single investor has. 1, is this a good business? And 2, am I paying a fair price for it? Let's start with the profitability pillar and its star player, return on equity, or ROE. Honestly, you could argue this is the single most important number. It answers a really simple question. For every single rupee that I, as an owner, have invested in this company, how much profit is the company making for me? It's the bottom line on performance from a shareholder's point of view. So what's a good ROE? A really solid rule of thumb is to look for at least 15%. And you might be wondering, why 15%? Well, think about it this way. You could stick your money in a super safe investment, like a fixed deposit, and get maybe 7 or 8%, right? Investing in a business is way riskier. So shouldn't you demand a much better return, like at least double? If you're not getting that, you really have to ask yourself if the risk is worth the reward. And here's what that 15% rule looks like in practice. You've got Laggard Inc. down at 8%. That's barely better than a safe bet. Not great. Then you have Average LTD, which hits our 15% mark. It's okay. It's acceptable. But then you see Superstar Corp at 25%. That is what an exceptional business looks like. That's a company creating serious value for its owners. All right, let's pivot to our second pillar, valuation. And we have to talk about the most famous ratio of all, the PE ratio, or price to earnings. It's actually pretty simple. If a company's PE is, say, 20, it just means investors are willing to pay 20 rupees right now for every 1 rupee of profit the company makes in a year. It's basically a report card on what the market thinks and expects from the company. But here's the catch. A high PE ratio, it's a real double-edged sword. On the one hand, it could mean the market sees an amazing, high-quality company and is betting on massive growth ahead. That's the positive view. But the negative view, it could just mean the stock is caught up in hype, it's totally overvalued, and the expectations are just unrealistic. A high PE by itself means nothing. It's all about the context. Okay, so we've got ROE for profitability and PE for price. But the real pros know you can never, ever look at just one ratio and call it a day. The real magic happens when you combine all these different insights into a single checklist. That's how you get that complete, holistic view. And there's a logical flow to this. You don't just jump to the exciting stuff. First, you start with an efficiency check.
Is the company actually using its resources well? Second, a safety assessment. Can it survive a tough patch? Can it pay its bills? Only if the answers are yes, do you move on to step 3, the return analysis. That's our ROE. And only after you've confirmed it's an efficient, safe, and profitable business do you finally get to the last step, the price check. Is the price you're being asked to pay actually reasonable?
So let's bring this all home. This final checklist is what I really want you to take away from this. Think of it as your secret weapon, a powerful tool that will help you analyze companies like a professional, and most importantly, help you steer clear of some very common investor traps.
So here's that full checklist in action. For activity, you're asking, is its asset turnover good compared to its peers? For liquidity, its short-term safety, you want to see a current ratio over 1.5. That means it has plenty of cushion to cover its immediate bills. Then solvency, long-term safety. Is its debt manageable? Is its interest coverage over 2.5 times? That shows it can easily handle its debt payments. Then we get to what we talked about, profitability. Is that ROE over our 15% hurdle? And finally, valuation. Is the PE ratio actually reasonable when you compare it to the company's growth prospects? See how it all connects? It's a full system.
But I have to end with this, and it's probably the most important point of all. Ratios, checklists, these are not magic wands that give you all the answers. They are tools. They are brilliant at showing you where to look, what questions to ask, and where the risks might be. But in the end, it's your own judgment that has to pull all those clues together to form real investment wisdom. So now you've got the framework. You've got the tools the pros use to look right past the headlines and find out what's really going on inside a business. The only question left is, the next time you look at a company, what story are the numbers going to tell you?